Hello everyone, this is 10th of January 2026 and today our backtest is going to be focused on the 9th of January, that's the NFP Friday, okay, non-farm payroll, NFP Friday, and our backtest is going to be focused mainly on the London session for gold. So I'll go into the charts, 5 minute time frame. So like I said earlier, the Q zone on my other videos, I normally say this. The Q zone for the London session is from 2 a.m. to 5 a.m. So this is actually ninth. This is the start of the day. Okay, ninth. You can see it on the screen. Ninth at the bottom. Ninth of January. So the Q zone is at the London session is from 2 a.m. to 5 a.m. That's when you hunt for setup on the London session. Okay, so this is a 5 minute chart. So before the opening of the day, before the start of the day, sorry, you can see how price went down to take out these two lows, this low and this low. So these lows, they are called what? They are called relative equal lows. Why? It is validated as a relative equal low because this low is slightly lower than this. Okay, and below them lies what? Sell side liquidity. So at the bottom left. Okay, so why is sell side liquidity lying at these lows? Okay, so traders who are long at this setup overall, traders who are long, they want to put their stop loss at these lows. Okay, they want to put their or trade their stop loss to these lows. Also, retail traders see these lows as a support. So once they see price breaks a support, they want to sell at the low. Okay, they want to continue. They want to sell. They want to sell at these lows. Okay, so they'll view this as a support. Then when they see this strong price movement down into it, they'll think it's a breakout. Okay, they'll think it's a breakout. Then when it comes up to this point, they want to sell at this point to go low further. But you see how price reacted to this. Okay, price took these lows out, the sell side liquidity, then rallied upward. Okay, now this is not our focus on trade for today, though. Not that it's not the main focus, but there is also a setup inside the London key zone, a replicant, like a replicant of this that also played out there in the London key zone. Okay, so this is actually the ICT 2022 mentorship model, okay, whereby price takes out sell side liquidity or buy side, then it displays upward or downward with it goes up or downward with displacement. Okay, so in this case, it's taking out sell side liquidity and see the displacement of this candle, see the length of this candle, and the length of this as well. Okay. Then the fair value gap being formed is really small. This is a 5 minute time frame actually. So this is the fair value gap. You see the high of this candle 12:20 a.m. and the low of this candle 12:30 a.m. Okay. So that's our fair value gap. This. So let me add the midpoint to it. Okay, so this is our fair value gap. I don't like the way it's being extended. Remove that. Remove extension. Okay, so this is our fair value gap. So this is a 5 minute fair value gap. That's how I will label it. 5 minute fair value gap. Okay. So now at the London key zone, that's when the algorithm implies we want to run to a point of interest. Okay. So okay, I'll take this off so you can focus on the key zone. So this is 2 a.m. and this is 5 a.m. right? So you see at 350, exactly at 350, price traded down into the fair value gap. Exactly at 350, price traded down into the fair value gap. Okay. And it rallied up to take out what this high right here. So this right here is buy side liquidity. So there's buy side liquidity at that high. So that's an idea of taking your profits if you are in a if you are in a trade like this. This is an idea of taking profit. So let's say you anticipate price to trade down to this fair value gap, 5 minute fair value gap right here. Then your stop loss will be at this low. Then you take profits. You want price to rally above this high, right? This is about 2.2 weeks to reward ratio. Not bad that high. And also, I said earlier that there's a replicant of this happening here on the key zone, inside the key zone. Immediately, price traded down to this 5 minute fair value gap. So we see that on the 1 minute time frame. Okay, here's a 1 minute time frame. Okay, just before going to the 1 minute time frame, let's see it on the 5 minute time frame. So you see this run down into this 5 minute fair value gap. This run down into the 5 minute fair value gap. You notice how it took out this low and this low. What are these lows called? They are called relative equal lows, just like these ones. And you see this low slightly lower than this is slightly lower than this. Validate it as a strong relative equal lows, a strong relative equal lows, and the sell side liquidity resting below those lows. Okay. So on the 5 minute time frame, we only see how price went down, actually went down to the 5 minute fair value gap and traded below this relative equal lows, then rallied upward, right? There's no sign of the fair value gap and all of that. But when you go to the 1 minute time frame, on the 1 minute time frame, this is how it looks. Okay, so when price traded inside the key zone, this is happening inside the key zone, 2 a.m. to 5 a.m. Okay, so price traded down into the 5 minute fair value gap at 3:52 a.m. You can see, and also simultaneously it's taking out these relative equal lows. See these lows right here. So side, so sell side liquidity resting at these lows. Okay, price took it out, and you see the gap up trades up with displacements. And right now on the 1 minute time frame, where's our fair value gap? This is our fair value gap. Okay, this is our fair value gap. So so you notice I didn't stop the fair value gap at this point. Why? Because there's a volume imbalance right here at the top. What's volume imbalance? Volume imbalance is the distance between the body of two different candles. So this candle, the body of this candle and this candle, you can see the wicks overlapping, but we focus on the body. Okay. So since there's a separation, there's a distance between the body of this candle and this candle. You make room for the volume imbalance. That's how you draw your fair value gaps, your CB imbalance correctly. Okay. So this is it. And you can see price actually didn't even Price traded down to the volume imbalance before rallying up. Okay, so this is our 1 minute fair value gap. After price traded into the 5 minute fair value gap, rallied up, took out relative equal lows, which um, which below them lies sell side liquidity. Then price rallied up with displacement, took out this short term low, short term high, sorry, took out the short term high, and created and formed the fair value gap. Okay, traded into the volume imbalance of the fair value gap and started running upward to take out buy side liquidity. And then you say take out buy side liquidity. And actually making this trade will give you a good risk to reward. Actually, it's about 3.2 risk to reward. That's very good. So I hope you found this insightful. So for a complete video on gold backtest, click the New York AM and PM section linked on the screen.